Later CPA and Associates, accounting done great by mate.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our ongoing series, the 20-week Tax Strategy Readiness Roadmap. You can get your firm ready with the best tax strategies. This week, we're going to be talking about owner's pay, draws, distributions, and payroll. Now, when you own a private practice, you need a way to move money from your business to your personal bank account. But the correct way to pay yourself depends on how your business is taxed. An owner might receive an owner's draw, a partnership distribution, a guaranteed payment, an S corporation distribution, or payroll wages. These terms may sound similar, but they're treated differently for taxes. Let's start with your tax structure. The letters LLC do not tell us how an owner should be paid. For federal tax purposes, a one-owner LLC is usually taxed as a sole proprietorship. An LLC with two or more owners is usually taxed as a partnership. An LLC can also elect to be taxed as an S corporation. The tax classification, not just the legal name, determines how the owner should be paid. Let's start with sole proprietors. A sole proprietor normally does not put themselves on payroll. Instead, the owner transfers money from the business account to a personal account. This is commonly called an owner's draw. The important point is that the draw does not determine the owner's taxable income. For example, the practice earns a $100,000 net profit. The owner only withdraws $60,000. The owner is still generally taxed on the full $100,000 profit. The draw itself is not a business expense. It does not reduce the profit reported on the owner's tax return. Sole proprietors generally report their business activity on Schedule C and may owe self-employment tax on the net business profit. Now, let's talk about partnerships. Partners are generally considered self-employed. They are not employees of the partnership and normally should not receive a W-2 from the partnership. Partners may receive money in two main ways. First is a distribution. A distribution is money taken out based on the partner's ownership in the business. The second is a guaranteed payment. This may be used when a partner receives a set amount for work performed regardless of how much profit the partnership earns. For example, two therapists own a practice together. Each receives a share of the annual profit. One therapist manages the employees and daily operations. The partnership agreement may provide that therapist with a guaranteed payment for the additional work. Partners generally report their share of partnership income even when the money remains in the business. Distributions also involve basis rules, so taking out more than a partner's available basis may create a taxable gain. That's not common, but I do see it happen occasionally. Now, let's talk about S corporations. An S corporation owner who works in the business is generally both an owner and an employee. That means the owner normally receives money in two ways: W-2 payroll wages for the work performed, and shareholder distributions based on ownership. An S corporation must pay the owner a reasonable compensation before replacing wages with distributions. Reasonable compensation means the wages should reflect the value of the work that the owner performs. Factors might include the owner's duties, hours worked, experience and training, management responsibilities, and what another business would pay for similar work. There is no automatic rule saying that the salary must be a certain percentage of revenue or profits. Proper S corporation distributions generally are not treated as payroll wages. However, the owner is still taxed on their share of the S corporation's profit, whether or not all the profit is distributed. Distributions must also be tracked against the shareholder's basis. A distribution above the available basis may become taxable. Again, not too common, but I do see it occasionally. Now let's talk about a couple common mistakes with owner pay. A few common mistakes: putting a sole proprietor on payroll, giving a partner a W-2, treating personal withdrawals as business expenses. That's a bad one. Don't do that. Taking S corporation distributions without running a reasonable payroll, assuming taxes are only owed when cash is withdrawn, taking distributions without tracking your basis, and mixing personal and business spending. Some of those are worse than others, but they're all bad mistakes. So remember, the payment method must match the business's tax structure. So in closing, the main lesson is simple. Sole proprietors normally take owner's draws. Partners normally receive distributions and may receive guaranteed payments. Working S corporation owners normally receive both payroll wages and distributions. Before you transfer money, ask yourself this: how is my business taxed, and is this payment being recorded correctly? The wrong payment method can create incorrect bookkeeping and missed payroll filings, unexpected taxes, and IRS problems. The right system makes it easier to understand your practice's profit, plan for taxes, and pay yourself consistently. Next week, we are talking about retirement plans as a tax strategy tool. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.
For all your tax needs.